Let's assume you now have control of your finances and you've removed the fees of a financial advisor and mutual fund manager. So what does risk look like now as a self-managed trader investor? Most of us will enter this space on our own and dabble a bit here and there, trying to make money by buying stocks and indexes low and then selling high. This is the starting level where K2 wants you to be. Here, but with some confidence in what you're doing and skills on how to trade with some fundamental investor insights. I think of myself 15 to 20 years ago, and it's relatively easy to just create an online brokerage account and start dabbling in the stock market. But I mean, this is really taking full control of all your finances and feeling comfortable doing so. That is where K2 wants you to get to be, at least with taking the course. So we will just call this risk level 1, or for an archetype, let's call it the trader/investor. And we use stocks. This is where we use stocks and indexes instead of mutual funds or a paid advisor. And once you start trading and investing on your own, you'll realize that your risk tolerance is different from what is determined from your financial advisor and the know your client process. Now you have to manage your own risk and emotions. It is way different when you're accountable for your own gains and losses. Your risk profile may be a bit of a blend of this if you're still somewhat skeptical or just wanting to ease into it. So after completing K2's Take Control course, you'll learn stock market fundamentals, technical analysis, and where to properly source information on the internet. This will allow you to be in a better position to trade and invest much easier with confidence. Much better than paying the additional fees that you would in a mutual fund once you're in control of your money. So by reading the fundamentals and financials about a company, you'll know what makes a company profitable and a risk to invest in. And by using your technical analysis and charting, you can identify entry and exit points based on the trends you identify in the business cycles. To start, you can use professional analyst company valuations to get a better feel for an undervalued company and whether you should invest in it or walk away from it. As you get more experience, you'll learn how to make your own valuations on companies, and that will give you even more insights and confidence to managing your own money. Just by using all those techniques, you'll create opportunities to get companies cheaply and sell them at profit or at highs in their cycles. This requires you to manage the amount of time you hold in a company in your portfolio and when to buy and sell on the market. But you can anticipate much higher returns than mutual funds when done correctly. And industry averages for traders are really all over the place, but as you develop your skills and are getting really generally better, you're going to get generally better returns in mutual funds. And I think that if you complete my K2 course, then you can expect returns that start at 15% and go up from there.